It didn't begin with innovation. It began with applause. Screens flashed green, headlines celebrated record returns, and executives smiled on earnings calls. But beneath the cheers, something fundamental had shifted. Quietly, invisibly. Companies were no longer competing to build the future. They were competing to buy it back. In boardrooms across America, trillions of dollars that once built factories, funded research, and paid workers were being redirected into a mirror. Money spent not to create, but to make the reflection look richer, and the most astonishing part. It wasn't hidden in some offshore account. It was announced publicly, celebrated as genius, rewarded with bonuses, and written into law. Picture this. It's November 2023, and Apple just announced something extraordinary. Not a revolutionary new iPhone, not a breakthrough in artificial intelligence, but the largest share buyback program in American corporate history. $110 billion. More money than most countries generate in an entire year, dedicated to a single purpose: buying their own stock back from investors. And here's the twist that would make your grandfather's generation dizzy with confusion. This wasn't just legal, this was celebrated. Wall Street cheered, stock prices soared, executives got richer. But 40 years earlier, what Apple just did would have sent its leadership to federal prison. This is empire economics, where money, power, and history collide. And today, we're diving into one of the most dramatic reversals in financial regulation history. A story that begins with a crime so dangerous, it helped trigger the Great Depression, transforms into the backbone of modern corporate strategy, and reveals how a single rule change in 1982 fundamentally rewired American capitalism. The numbers alone tell an impossible story. In 2024, American corporations spent nearly $1 trillion buying back their own shares. That's more than the entire gross domestic product of most developed nations. It's money that could have built infrastructure, funded research, raised wages, or expanded businesses. Instead, it vanished into the mathematical ether of share reduction, creating wealth out of accounting tricks rather than actual value. But to understand how we arrived at this point, we need to go back to a time when this practice wasn't just frowned upon, it was criminal. The year was 1929, and America was drunk on stock market speculation. Corporate executives had discovered a clever trick. They could buy their own company's shares, driving up the price, then sell at a profit, while ordinary investors got crushed when the artificial bubble collapsed. It was pure manipulation, dressed up as legitimate business. The practice was so widespread, so blatantly fraudulent, that when the market finally crashed in October of that year, wiping out fortunes and triggering the Great Depression, regulators knew exactly where to point the finger. Enter Joseph Kennedy, father of the future president, and a man who knew every trick in the speculator's playbook because he had used most of them himself. When Franklin Roosevelt created the Securities and Exchange Commission in 1934 to clean up Wall Street's mess, he made a choice that shocked everyone. He put Kennedy in charge. Roosevelt's logic was brutally simple, as he reportedly told actress Gloria Swanson, "It takes a crook to catch a crook." Kennedy's SEC moved swiftly and decisively. Stock buybacks were banned outright. Corporate executives who manipulated their share prices through repurchases faced serious federal charges. The message was crystal clear. Companies existed to create value for customers, workers, and society, not to play mathematical games with their own stock certificates. For nearly 5 decades, this remained the law of the land. Buybacks were relegated to extraordinary circumstances, requiring extensive justification and regulatory approval. Then came 1982, and everything changed. Ronald Reagan had swept into the White House promising to unleash American business from the shackles of government regulation. His administration viewed the New Deal-era restrictions as outdated obstacles to economic growth. The Securities and Exchange Commission, now led by Reagan appointee John Shad, began systematically dismantling the protective barriers that had been built after the Great Depression. On November 17, 1982, the SEC quietly issued Rule 10b-18. Most Americans had never heard of it. Financial journalists barely covered it. But this obscure regulatory change would prove to be one of the most consequential policy shifts of the 20th century. With the stroke of a pen, the SEC created a safe harbor for companies engaging in stock buybacks, effectively legalizing what had been criminal activity for half a century. The transformation wasn't immediate, but it was inevitable. Like water finding cracks in a dam, corporate America began testing the boundaries of this new freedom. What started as a trickle of buyback activity in the mid-1980s became a steady stream in the 1990s, then a raging torrent in the 2000s, and finally the dominant force in corporate finance that we see today. The mechanics of the scheme are elegantly simple, which is precisely what makes them so dangerous. Every company's stock price is influenced by a basic calculation, earnings per share. Take the company's total profits and divide by the number of shares outstanding. It's one of the most fundamental metrics investors use to evaluate whether a stock is expensive or cheap. Now, there are two ways to improve this number. The healthy way involves actually improving the business, selling more products, entering new markets, innovating better services, increasing genuine profitability. This requires vision, leadership, risk-taking, and time. It's hard work with uncertain outcomes. The buyback method is different. Instead of growing the numerator by increasing earnings, companies shrink the denominator by reducing share count, same profits, fewer shares, higher earnings per share. On paper, the company looks more profitable without changing a single aspect of its actual business performance. It's financial alchemy, turning mathematical manipulation into apparent business success. But here's where the story gets truly insidious. The executives making these buyback decisions aren't neutral observers. They're the primary beneficiaries of the resulting stock price increases. More than 30% of executive compensation packages are directly tied to earnings per share metrics. When a CEO authorizes a massive buyback program, they're not just managing corporate resources, they're engineering their own wealth. The timing advantages are even more troubling. While employees face strict trading restrictions around major corporate announcements, executives operate under more flexible rules. A 2018 SEC study revealed a disturbing pattern. Company insiders were twice as likely to sell their personal stock holdings in the days immediately following buyback announcements. They announce the buyback, watch the stock price rise on the artificial scarcity they've created, then cash out their personal holdings at the inflated prices. This is where the manipulation becomes unmistakable. These executives possess material non-public information about their buyback timing and scale. They know exactly when artificial demand will drive up share prices, and they systematically profit from this knowledge while ordinary investors remain in the dark. The wealth concentration effects are staggering and undeniable. In 1982, the same year buybacks were legalized, the average CEO earned 50 times what a typical production worker made today. That ratio has exploded to 144 times average worker compensation. The connection isn't coincidental. As buybacks became the dominant form of corporate capital allocation, executive wealth skyrocketed while worker wages stagnated. But the real kicker is this: 84% of all stock market wealth is concentrated in the hands of the top 10% of American households. The bottom 80% of families own just 7% of total stock market value. When companies spend hundreds of billions on buybacks instead of investing in wages, research, or expansion, they're effectively transferring wealth from the productive economy into the portfolios of the already wealthy. The most revealing case study isn't a nameless corporation buried in financial footnotes. It's Apple, the company that revolutionized personal computing, transformed how we listen to music, and redefined the smartphone. The same company that spent $621 billion over the past decade buying back its own shares. More money than most countries will generate in their entire existence. Let's put that number in perspective. Apple's buyback spending since 2013 exceeds the gross domestic product of Belgium, Austria, or Israel. It's more than the combined market capitalization of Netflix, Tesla, and McDonald's. It represents wealth on a scale that dwarfs the budgets of entire governments, and Apple chose to spend it not on innovation, not on expanding into new markets, not on raising worker wages, but on mathematical manipulation of its share count. The timing tells an even more troubling story. In 2024, as iPhone sales declined 10% year over year, Apple announced that record-breaking $110 billion buyback. Think about the message this sends. When customers are buying fewer products, when competition is intensifying from Samsung and Chinese manufacturers, when the company faces its most challenging market conditions in years, management's response wasn't to innovate harder or reduce prices. It was to inflate the stock price through financial engineering. This is where the buyback system reveals its most fundamental flaw. It transforms companies from engines of innovation into vehicles for wealth extraction. Apple spent $77 billion on buybacks in fiscal 2023. During that same year, the company invested $30 billion in research and development. Let that sink in. America's most valuable technology company spent more than twice as much manipulating its stock price as it did developing new technologies. The opportunity cost is staggering when you consider what else could have been accomplished with those resources. $77 billion could have funded cancer research for decades, built high-speed rail networks, provided college education for hundreds of thousands of students, or launched ambitious clean energy projects. Instead, it evaporated into the ether of reduced share count, creating no new products, no new jobs, no technological advancement. But Apple isn't alone in this financial theater. Across corporate America, the same pattern repeats with mechanical precision. Companies facing declining revenues announce massive buyback programs. Stock prices rise on the artificial scarcity. Executives cash out their personal holdings at inflated valuations. Shareholders celebrate the short-term gains while the underlying businesses slowly hollow out from lack of investment. The scale has reached levels that would have been incomprehensible to previous generations. Annual buyback spending has quadrupled since 2010, reaching nearly $1 trillion in 2024. Goldman Sachs projects that 2025 will break the trillion-dollar barrier for the first time in history. We're witnessing the largest sustained wealth transfer from productive economic activity to passive financial ownership in recorded history. This isn't happening in some shadowy corner of finance. It's occurring in broad daylight, celebrated in earnings calls, featured prominently in corporate press releases, and cheered by financial media. What was once considered criminal market manipulation has become the primary mechanism through which public companies allocate capital. The transformation is so complete that questioning buybacks now sounds radical, even though they were illegal for most of American history. So here we stand, witnesses to one of the most dramatic reversals in financial history. A practice that once sent executives to prison now defines corporate strategy. What began as illegal market manipulation in 1929 became the trillion-dollar engine of modern capitalism through a single regulatory stroke in 1982. The numbers don't lie, the patterns are clear, and the transformation is complete. Understanding this history doesn't just explain how markets work today. It reveals how quickly the rules of money can change and why that knowledge matters for anyone trying to navigate an economy built on shifting foundations. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If you enjoy learning how history and money intertwine, subscribe to Empire Economics for more untold stories.